Have you ever wondered how the stock market works? Why so many people are drawn to it? The allure of the stock market is multifaceted and quite captivating. At first glance, it's a world of numbers, charts, and ticker tapes, but delve a little deeper, and you'll find it's a thrilling arena of opportunity and potential. The stock market is not just a playground for the wealthy. It's a place where anyone with a little spare cash and a lot of curiosity can participate. It presents the potential for profit, from those looking to make a quick buck to those aiming for long-term financial security. The excitement of the trading floor, the buzz of a successful investment, the chance to be a part of a company's growth story, all these elements add to the appeal of the stock market. But remember, with great potential comes great responsibility. The stock market holds an undeniable allure, but understanding it is key to success. Before jumping into the stock market, grasp the fundamentals. It's a mantra that holds true for anyone embarking on the journey of investing. So let's start by understanding what stocks are. In the simplest terms, stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, becoming a shareholder. This ownership stake gives you a claim on the company's assets and earnings. Now you may wonder, why do companies issue stocks? Well, companies issue stocks to raise money. They could use this money for a variety of reasons, from expanding their business operations to paying off debt. So, how do you buy stocks? That's where stock exchanges come in. Stock exchanges are organized marketplaces where stocks are bought and sold. Some of the most famous stock exchanges include the New York Stock Exchange and the Nasdaq. When you decide to buy a stock, you place an order through a brokerage, which is a firm that acts as a middleman between you and the stock exchange. The price you pay for the stock is determined by supply and demand. If a lot of people want to buy a stock, the price goes up. If a lot of people want to sell a stock, the price goes down. But remember, buying stocks isn't like shopping at your local supermarket. It's not just about price, it's about value. The value of a stock is based on a multitude of factors, including the company's earnings, the state of the economy, and investor sentiment, among other things. Also, it's important to note that when you buy a stock, you're not guaranteed to make money. Stocks can go up, but they can also go down. That's why investing in the stock market involves risk. But as the saying goes, no risk, no reward. So there you have it, the basics of the stock market. Stocks, stock exchanges, brokerages, supply and demand, value, and risk. These are the fundamental building blocks of investing. With the basics down, you're ready to start setting your financial goals. Why are you investing? Your answer sets your financial goals. It's a simple question, but a profound one. The answer shapes your financial future, guiding your investment strategy with a clear sense of direction. Fundamentally, investing is about securing your financial future. It's about taking control of your hard-earned money and making it work for you. But to do that effectively, you need to know what you're aiming for. That's where financial goals come in. Financial goals are the targets you aim to hit with your investments. They give you a clear sense of purpose, a roadmap to your financial future. They could be anything from saving up for a down payment on a house, building a college fund for your kids, or growing a retirement nest egg. The important thing is that they align with your personal financial needs and aspirations. Setting clear, measurable, and achievable financial goals is crucial. Clear goals are specific, detailing exactly what you want to achieve. They're not vague aspirations, but concrete targets. For instance, instead of saying you want to save for retirement, specify how much you aim to accumulate by a certain age. Measurable goals allow you to track your progress. If your goal is to build a retirement fund of $1 million, break it down into smaller milestones. This makes the task less daunting and gives you a sense of achievement as you hit each milestone. Achievable goals are realistic. They consider your income, expenses, and other financial responsibilities. They're ambitious, but within reach. Setting unattainable goals can lead to frustration and may discourage you from investing altogether. Your financial goals guide your investment strategy. They help you decide how much to invest, what type of investments to make, and how much risk to take on. They keep you focused when the market gets rocky, reminding you of why you're investing in the first place. So take a moment to ask yourself, why am I investing? Reflect on your financial needs and dreams. Then set clear, measurable, and achievable goals to guide your investment journey. With clear financial goals, you can better navigate the risks and rewards of the stock market. Investing always involves a degree of risk. How much can you tolerate? Now, this isn't a question about your capacity to stomach spicy food or endure a grueling workout. It's about understanding how much financial risk you're willing to take on as you venture into the world of investing. It's about finding your risk tolerance. In the realm of investing, risk and reward go hand in hand. The potential for higher returns often comes with a higher degree of risk. Think of it as a roller coaster ride. The higher and faster the ride, the more exciting it can be, but it also brings about more fear and apprehension. To determine your risk tolerance, you need to take a good look at your financial situation and your emotional comfort with uncertainty. A few factors to consider are your investment goals, your time horizon, and your financial capacity to absorb losses. Your investment goals could be anything from saving for retirement, buying a house, or funding your child's education. The timeline for these goals will impact how much risk you can take. If your goal is decades away, you might be able to take on more risk compared to a goal that is only a few years away. Your financial capacity to absorb losses is also crucial. Remember, investing is not about risking all you have. It's about growing your wealth responsibly. If a potential loss could significantly disrupt your life or your ability to meet your financial obligations, then that investment might be too risky for you. On the emotional side, think about how you would react if your investments declined in value. Would you lose sleep? Would you panic and sell? Or would you stay the course, trusting in your long-term strategy? Understanding your risk tolerance is not a one-time event. It's a continuous process, and it might change as your life circumstances change. It's an essential step in making informed investment decisions. It guides you in choosing the right investment products, in knowing when to hold on and when to let go. Knowing your risk tolerance helps guide your research into potential investments. So, before diving headfirst into the stock market, take a moment to reflect on your risk tolerance. It's your compass in the exciting yet unpredictable world of investing. Investing isn't a gamble, it's a calculated decision based on thorough research. Let's draw back the curtain on the exciting world of stock market research. This process is akin to detective work, where you piece together a company's financial puzzle to make an informed investment decision. Researching stocks is like getting to know a potential partner. You wouldn't go on a date without first knowing a little about the other person, would you? The same applies to investing. Before buying shares, you need to understand the company's financial health, its competitive standing, and its future prospects. First, let's talk about financial health. This involves analyzing a company's balance sheet, income statement, and cash flow statement. It's like a health checkup, where you measure the company's financial fitness. You're looking for positive cash flow, low debt, and consistently growing earnings. Next, we have the company's competitive standing. This is where you examine the company's position in its industry. Is it a leading player or a small fish in a big pond? Understanding this can help you gauge the company's ability to sustain growth and profitability. Then we have future prospects. Here, you're trying to forecast where the company could be in 5, 10, or even 20 years. You'll want to look at the company's strategy, its growth opportunities, and potential threats. Now, you may be wondering where to find all this information. The good news is, it's readily available online. Companies publish their financial reports on their websites, and many financial news outlets provide analysis and commentary. There are also numerous online platforms that offer detailed stock analysis and ratings. Remember, stock market research isn't about finding the perfect stock. It's about understanding the risks and rewards associated with each investment. It's about making informed decisions, not taking wild guesses. So, take the plunge. Dive into the world of stock market research. It's a fascinating journey that can lead to rewarding investments. Armed with research, you're ready to start building your portfolio. Don't put all your eggs in one basket. Diversify your portfolio. This adage is a tried and true investment principle. But why is it so crucial? Well, It comes down to one word: risk. Diversification is the process of spreading your investments across various assets, reducing your exposure to any single investment's potential downfall. Think of diversification as a safety net. It's like having multiple parachutes instead of just one. If one fails, you have others to fall back on. Similarly, if one of your investments doesn't perform as expected, the others in your portfolio can help cushion the blow. Now let's delve a little deeper. A diverse portfolio isn't just about having a mix of different stocks. It's about having a variety of asset types: stocks, bonds, real estate, commodities, even cryptocurrencies. The idea is that these different asset classes don't move in the same direction at the same time. When stocks are down, bonds might be up. When real estate is sluggish, cryptocurrencies might be soaring. The benefits of a diverse portfolio are plentiful. Firstly, it helps manage and distribute risk. You're not reliant on a single investment or a single asset class. Secondly, it can provide a more stable and potentially higher return over the long term. Diversification allows you to take advantage of the unique opportunities each asset class offers while mitigating the unique risks they present. However, it's important to remember that diversification is not a one-size-fits-all strategy. It should be tailored to your financial goals, risk tolerance, and investment horizon. What works for one investor may not work for another. It's about finding the right mix that works for you. In conclusion, diversification is an essential strategy for any investor looking to build a robust and resilient portfolio. It's about spreading the risk, maximizing returns, and ultimately achieving your financial goals. A diverse portfolio sets the stage for understanding key stock parameters. Scene script. Stock parameters are your compass in the world of investing. Let's start with the price-to-earnings ratio, or PE ratio. This gives you a sense of the company's value by comparing its current share price to its per-share earnings. A high PE ratio could mean the stock's price is high relative to earnings and possibly overvalued. Conversely, a low PE might indicate that the current stock price is low relative to earnings. Next up is the price-to-book ratio, often referred to as PB ratio. This compares a company's market value, or stock price, to its book value, or shareholders' equity. A lower PB ratio could mean that the stock is undervalued, but it could also mean something is fundamentally wrong with the company. Return on equity, or ROE, measures a corporation's profitability by revealing the profit a company generates with the money shareholders have invested. A high ROE indicates that the company is using its investors' funds effectively. Return on capital employed, or ROCE, is another profitability ratio. It tells us how well a company is generating profits from its capital. A higher ROTE indicates more efficient use of capital. Dividends are the portion of corporate profits paid out to stockholders. If a company has a history of paying high dividends, it could be a sign of financial health. However, it's also important to note that not all successful companies pay dividends. Lastly, let's touch on the Relative Strength Index, or RSI. It's a momentum indicator that measures the speed and change of price movements. An RSI of 70 or above suggests that a stock is becoming overbought or overvalued and may be primed for a trend reversal or corrective price pullback. An RSI of 30 or below indicates an oversold or undervalued condition. Navigating the stock market can feel like sailing in uncharted waters. But these parameters are like a lighthouse guiding your investment decisions. They can provide insights into a company's financial health, market valuation, profitability, and price momentum. These parameters can guide your timing in buying and selling stocks. Timing can make a difference between profit and loss in the stock market. When it comes to buying and selling stocks, the question of when often looms large. It's like a game of chess where your next move can either propel you towards victory or send you spiraling towards defeat. But don't worry, it's not all a guessing game. There are strategies to help you decide the best times to make your move. Firstly, let's talk about buying. A common strategy is to buy low. This means purchasing stocks when their prices are down. But how do you know when a stock is truly undervalued? This is where your research skills come into play. Look at the company's fundamentals, the industry it belongs to, and the overall market conditions. If a company looks solid but its stock is trading for less than its intrinsic value, it might be a good time to buy. Now let's switch gears to selling. The counterpart to buy low is, you guessed it, sell high. When a stock's price has risen significantly, it could be a good time to sell and cash in on your profits. But be careful not to get too greedy. It's impossible to predict the exact peak of a stock's price, and waiting too long could mean missing out on the best time to sell. Another strategy is to set price targets. This involves deciding in advance the price at which you'll sell a stock, either to take profits or to limit losses. This can help take emotions out of the equation and prevent hasty decisions. Lastly, remember that timing isn't everything. While it's important, it should not overshadow other critical aspects of investing like diversification, research, and long-term financial goals. With timing mastered, you're ready to explore common investment strategies. There are many ways to approach investing. What's your strategy? Let's delve into the labyrinth of common investment strategies, each with its own unique allure and benefits. First up, we have value investing. Popularized by the Oracle of Omaha himself, Warren Buffett, this strategy is all about hunting for stocks that appear underpriced by some form of fundamental analysis. In essence, it's like scouring a garage sale for hidden gems, stocks that are undervalued by the market, but have the potential to shine in the long run. Next, we have growth investing. This strategy is for those who believe in the motto, "Sky is the limit." Growth investors seek companies that exhibit signs of above-average growth through revenues or earnings, even if the share price appears expensive in terms of metrics such as price-to-earnings or price-to-book ratios. It's like betting on the fastest horse in the race, hoping that its speed will lead it to the finish line first. Finally, let's talk about income investing. This strategy is for those who prefer a steady stream of income. Income investors seek stocks that pay regular dividends and have a history of stable dividend payments. Think of it as investing in a golden goose that lays golden eggs regularly, providing a steady income over time. Now, it's important to remember that no strategy is a one-size-fits-all. Each investor has different financial goals, risk tolerance, and investment horizon. Some might prefer the thrill of growth investing, while others might find solace in the steadiness of income investing. Some might enjoy the hunt for undervalued stocks, as in value investing. The beauty of investing is that it's as diverse as the investors themselves. It's a canvas where you paint your financial future using the colors of your choice. So, ponder, research, understand, and then choose the strategy that aligns best with your financial goals and risk tolerance. An investment strategy shapes how you navigate stock market tools and platforms. So having a clear strategy is like having a compass that guides you through the vast sea of investing. Now let's sail forward to the world of stock market tools and platforms. The right tools can make your investment journey smoother. In the world of investing, there's a vast array of platforms and tools available at your disposal, each with its own unique features and functions. Let's start with stock market platforms. There are traditional brokerages that provide a wide range of financial services beyond just stock trading. They often come with comprehensive research tools and educational resources. Then there are online brokerages, which offer convenient, user-friendly platforms for buying and selling stocks. These platforms often come with lower fees, making them a popular choice for many investors. Next, we have robo-advisors. These automated investment platforms use algorithms to manage your portfolio based on your financial goals and risk tolerance. They're a great option if you're looking for a hands-off approach to investing. Now let's talk about stock market tools. These come in many forms, from stock screeners and charting tools to financial news aggregators and social trading platforms. Stock screeners allow you to filter stocks based on specific criteria, while charting tools help you analyze stock price movements. Financial news aggregators keep you updated with the latest market news, and social trading platforms allow you to follow and copy the trades of successful investors. Using these tools effectively involves understanding what each tool offers and how it can help you achieve your investment goals. For instance, if you're a beginner, you might find educational resources and social trading platforms particularly useful. If you're more experienced, you might prefer using advanced charting tools and financial news aggregators to make informed investment decisions. Remember, while these tools can be incredibly helpful, they're not a substitute for sound investment strategy. It's crucial to conduct your own research, understand the risks involved, and make decisions based on your financial goals and risk tolerance. In conclusion, navigating the world of stock market tools and platforms can seem daunting at first, but with a little bit of knowledge and practice, you can use these tools to enhance your investment journey. Equipped with the right tools, consider the psychology of investing. Investing isn't just about numbers, it's also about mindset. Let's delve into the psychology that underpins our investment decisions. Every investor, whether novice or seasoned, is influenced by their emotions. Managing these emotions plays a crucial role in investment outcomes. The thrill of a winning trade or the anxiety of a losing one can cloud judgment, leading to impulsive decisions. It's essential to keep emotions in check and not let them dictate investment choices. Developing a disciplined approach, sticking to a well-thought-out plan, and keeping realistic expectations can help in steering clear of emotional investing. Another crucial psychological aspect is cognitive bias, which can skew our perception and decision-making. Two common biases investors often grapple with are confirmation bias and overconfidence bias. Confirmation bias is the tendency to seek out information that supports our preconceived notions while disregarding contrary evidence. Overconfidence bias, on the other hand, is the belief that our skills, intelligence, or intuition are superior to others, leading to excessive risk-taking. To counter these biases, it's essential to maintain an open mind, continually question our assumptions, and seek out diverse viewpoints. It's also important to be honest about our abilities, recognize the role of luck in investing, and avoid overestimating our knowledge or skill. An often overlooked aspect of investing psychology is the fear of missing out, or FOMO. This fear can lead investors to jump on an investment bandwagon without proper evaluation, often resulting in poor investment outcomes. To combat FOMO, it's advisable to stick to your investment strategy and avoid getting swayed by market trends or hype. Lastly, the value of patience cannot be overstated. Investing is a long-term endeavor, and it takes time for investments to bear fruit. Patience, coupled with discipline, can help investors weather market volatility and stay on course towards their financial goals. In conclusion, understanding the psychological aspects of investing is as important as understanding financial metrics and market trends. It helps us to manage our emotions, avoid cognitive biases, and make sound investment decisions. Understanding the psychological aspect of investing prepares you to learn from both mistakes and successes. Mistakes can be valuable teachers. Successes can be deceptive masters. This is especially true in the world of investing. As we embark on our investing journey, it's inevitable that we'll make mistakes along the way. Perhaps we buy a stock too high or sell too soon. Maybe we let our emotions get the best of us and panic when the market dips. These missteps, while painful, are invaluable learning opportunities. They teach us to be patient, to stay the course, and to make decisions based on careful research and analysis, rather than reacting to market fluctuations. Mistakes can also teach us about risk. They remind us that investing is not a guaranteed path to wealth, but rather a calculated gamble. They force us to reassess our risk tolerance and to diversify our portfolios, spreading our bets across different sectors and asset classes. But what about successes? Surely they're all good, right? Well, not always. Success can lull us into a false sense of security, making us overconfident and prone to taking unnecessary risks. A few wins can make us feel invincible, leading us to disregard the fundamentals and chase after the next big thing. Success can also make us complacent. We may stop learning, stop questioning, stop evolving. We may start to believe that we have the Midas touch, that every investment we make will turn to gold. But the market is ever-changing, and what worked yesterday may not work tomorrow. So how can we learn from our successes? First, by recognizing that luck can play a part in our victories. Second, by analyzing our wins as thoroughly as our losses, understanding why we succeeded, and how we can replicate that success in the future. And third, by staying humble and grounded, remembering that the market owes us nothing. In conclusion, both mistakes and successes are essential parts of the investing journey. They shape us, guide us, and ultimately make us better investors. With these lessons, you're ready for the lifelong journey of investing. Investing isn't a get-rich-quick scheme. It's a lifelong journey. A journey that begins with understanding the allure of the stock market, the basics, and setting clear financial goals. A journey that involves assessing risk and reward, diving deep into research, and building a diverse portfolio. It's a journey where you navigate the many tools and platforms available, all while understanding how certain stock parameters influence your decisions. This journey is also about timing, about knowing when to buy and sell. It's about learning different investment strategies, and importantly, it's about understanding the psychological aspects of investing. Because investing isn't just about numbers and graphs, it's about people, their fears, their dreams, their mistakes, and their successes. So as we embark on this journey, we must remember to learn from our mistakes and successes, to continually educate ourselves, and to never stop exploring. Remember, the world of investing awaits. It's a journey, not a destination.